All right, today we're jumping into a real cornerstone of fair lending, Regulation B. Now, this is the rule that gives the Equal Credit Opportunity Act, ECOA, its teeth. It spells out exactly how creditors have to treat every single applicant fair and square.
So let's start with a question that really gets to the heart of why this matters. Because for anyone in compliance, or even if you're just studying for a certification exam, this is the big challenge, right? It's not about catching someone who is deliberately discriminating. It's about making sure your own systems and your own processes aren't accidentally creating discriminatory results.
So first things first, let's look at the foundation, the Equal Credit Opportunity Act. This law has been around since the 70s, and its goal is huge and powerful: to make sure that every single creditworthy applicant gets a fair shake. You can think of ECOA as the what. It's the fundamental principle of fair lending.
And if ECOA is the what, then Regulation B is the how. This is the detailed instruction manual that comes from the Consumer Financial Protection Bureau, the CFPB. It lays out exactly what creditors must do, and more importantly, what they absolutely can't do. This is what turns that big idea of ECOA into concrete, actionable rules for the real world.
Okay, this slide right here, this is the absolute core of the regulation. This is the prohibited basis. A creditor cannot, I repeat, cannot base a credit decision on any of these protected characteristics. Now, for anyone taking an exam, this list is non-negotiable. You have got to know it cold. And for you compliance pros, this is the bedrock of your entire fair lending program.
And here's a really crucial point: the scope. The law says a creditor can't discriminate regarding any aspect of a credit transaction. This isn't just about the final yes or no on the loan. That little phrase means these rules apply to, well, everything. We're talking about the ads you run, how you take the application, the underwriting, the pricing, how you service the loan, and even what you do in collections. It is a comprehensive cradle-to-grave requirement.
Now, this is where compliance gets really tricky. It's something called the effects test, or what you might have heard of as disparate impact. Here's the deal. A policy can seem totally neutral. For example, maybe your bank sets a minimum loan amount of, say, $250,000. But if that rule ends up disproportionately shutting out a protected group in your area, and you can't prove it's an absolute business necessity, that policy could be seen as discriminatory. This is exactly where that unintentional non-compliance we talked about can get you into hot water.
Okay, so let's see how this all plays out in day-to-day procedures. When you deny an application, or maybe you make a change that's not in the customer's favor, the rule calls that an adverse action. This definition is so important because taking an adverse action triggers a very specific set of things you have to do. And get this, even a counteroffer that the applicant turns down, yep, that counts as an adverse action too.
And here are those requirements. The adverse action notice is a procedural pillar of Reg B. So once you get a complete application, a 30-day clock starts ticking. You have to send a notice, it's got to be in writing, and, this is key, it must give the specific reasons for the denial. You can't be vague. You can't just say bad credit history if the real problem was too many recent inquiries. Specificity is everything. And finally, you have to include that standard ECOA notice, which points the applicant to your federal regulator.
Regulation B also gets very specific for certain types of loans. If you're dealing with a loan that's secured by a first lien on a dwelling, think your standard home purchase, you have a strict duty to give the applicant copies of all the appraisals and valuations. And the timing here is absolutely critical. You have to tell them about this right within 3 business days of application, and you have to get them the actual copies promptly, but no later than 3 business days before the closing. So what about holding on to all this paperwork? What's the record-keeping rule? The magic number is 25 months. You need to keep applications, all the stuff used to evaluate them, and any notices you sent for 25 months after you've notified the applicant. So why the weird number? Well, it gives you a little buffer on top of the 2-year statute of limitations for someone to file an ECOA lawsuit. This is a number every auditor is going to look for. All right, so let's talk about a huge development in Regulation B, something called Subpart B. This is a game changer. It now requires financial institutions to collect and report a ton of detailed data on applications from small businesses, with a special focus on those owned by women and minorities. The whole point is to help enforce fair lending laws and to get a better picture of where credit and capital are and are not flowing in our communities.
So, what kind of data are we talking about here? Well, the requirements are incredibly specific. You can see you have to collect and report the business's gross annual revenue, its industry code, what you ultimately did with the application, and, the really big one, demographic information about the business's owners. For the industry, getting the systems in place to do this is a massive, massive operational lift.
And this brings us to maybe the single most critical operational challenge of the new rule, the firewall. The rule is crystal clear on this. The demographic data you collect about the business owners cannot be seen or used by anyone who's actually making the credit decision. Your loan officers, your underwriters, they have to be shielded from this information so it can't possibly influence their decision. This requires some really strict internal controls and a clean separation of duties.
Now, the stakes for getting any of this wrong, they are incredibly high. The law allows for civil liability, which means actual and punitive damages. And for class action lawsuits, those punitive damages can go up to $500,000 or 1% of the creditor's net worth, whichever is less. We're not just talking about a slap on the wrist from a regulator, this is significant legal and financial risk.
Which, brings us to our final thought. From the big principles of ECOA all the way down to the nitty-gritty technical rules of Subpart B, Regulation B demands a living, breathing compliance framework. This is not a set-it-and-forget-it kind of rule. It needs constant attention, constant training, and constant testing to make sure fairness is built into every single thing you do. So the question to leave you with is your framework truly ready for that scrutiny?